This is a moment for all of us.
Fire, fire. 10, 9, 10, 11, 12, 13, 14, 15, 16, 19, 20.
Welcome back to Launch Window Research. Today I'm joined by Kenny, and we're going to be looking at Virgin Galactic because they've sort of taken a bearish turn in the past few months, and we haven't gotten around to covering it, so this video is pretty long overdue. Kenny, welcome to the channel.
Hey, thanks for having me, Nathan. Always a pleasure to be here.
So let's start by taking a look at Virgin Galactic's price action. It's not looking great, is it?
No, it's actually doing the opposite of looking great. So I'm not a official chartered market technician, but I've been doing this for a while. And I can tell you the yellow line being Virgin Galactic is all the way down there. That's a technical term. And that's even relative to kind of more speculative names like RK, for instance. And I put that on there, obviously, just to show you that even against high beta, highly volatile names, it's still not doing or performing well.
I think we'll go on to the next slide right now. And that is basically the fin box, which shows us the fundamentals of Virgin Galactic right now. And they're a bit nuanced. So Kenny, do you want to explain it?
So I want to just draw your attention to three things here. So first thing is a levered free cash flow. Their burn rate is looking at about negative 253 million. That's year on year. The other thing I want to draw your attention to is shares outstanding. So shares outstanding is just how much they dilute shares or how many offerings they do to raise money. 258.6 million. That's where it's at now. But as you see here, it stair steps up, which means they've had at least 3 or 4 public offerings at this point. The piece of the pie is bigger, so you own less and less of the company as they dilute shares. But the biggest reason I'm bringing that up is this current ratio. So current ratio is how many years they can survive without any more inflows in cash. And it's actually substantial, 6.6 years. That's not truly healthy. A healthy current ratio for a mature company is something like 1 to 2, 2.5 maybe max, unless you're trying to acquire or do some M&A, or you have some heavy capital expenditures in the kind of forefront of your mind. I think what's happening here is that they have a large runway because they are really worried about some of the technical limitations and some of the technical things that they have to work through.
Gotcha. So they've been diluting like crazy. I mean, partially because they went through an extreme hype cycle. I'm sure they realized their company was overvalued and it was an opportunity to raise money. And because of that, sort of at the investor's expense, they do have a decent bit of runway.
Sure, and that's completely awesome too. I mean, no fault of the CFO to take full advantage of a stock that's kind of gone parabolic, not for no reason, but pre-launch.
So that brings us on to our first bit of news with Virgin Galactic. They have pushed back commercial flights to 2023. They've already pushed this back, a couple years by now. But this is a company that has not flown a single paying customer in its entire existence. There's a really funny thing I've noticed, and it's that in the past few months, supply chain and labor constraints have been the sole reason for every single company's shortcoming. That can partially be blamed, but it can also be blamed on bad management because good companies will generally be able to weather the storm, but that's not what we're seeing with Virgin Galactic.
I can see semiconductors being a shortage here, but like outside of that, some of the things that they're looking at, I mean, they're not trying to haul out 200 million cars, right? It's literally a few airplanes. So while bespoke, I feel like they can get around that and kind of ship their stuff via airplane. I don't think they have massive freight going into their hangars in New Mexico. So it just baffles me how they can use this kind of excuse.
Yeah, exactly. So now we can take a look at the flight update. They've currently got 2 spaceships that they're going to operate next year, which is VSS Unity and VSS Imagine. VSS Imagine is the first of their Spaceship 3 series, so that means it's going to be made out of stainless steel. It has a few production and reliability improvements overall. Moving into 2023, it's looking like they're going to want to fly VSS Unity once a month and then VSS Imagine twice a month. So that's going to give them a rate of 36 flights per year. That's not exactly a lot of flights, and I've done a little bit of back of the napkin math here. So 3 space flights per month is 36 per year, and that would take them a whole 4 years to fulfill just the pre-orders that they've already secured, basically. And that would give them an average revenue of $67 million between now and 2026. Giving it a simple price to earnings ratio of 30, that would value the company at $2 billion. And it's currently at like roughly 1.6, and that's all-time lows of 1.6. $2 billion by 2026 gives them a CAGR of 5%, which is less than the SPY average. So this is not looking particularly good. What I would say here is basically they're going to have to grow faster if they want to maintain investments.
Yeah, Nathan, according to most analyst estimates, they have to grow at 10 times the rate that they're growing at right now, given the next 5 years, in order to maintain just the current price. So that's not my back of the napkin math, but that's other analysts taking a look at it.
10 times as many flights is going to be a whole lot, and we're going to talk about what it would mean for them to up the flights to that high of a cadence. But before we do that, I want to give a brief word on the problem with growth for Virgin Galactic. It's the fact that as they grow, they're not going to proportionally raise their revenues, because as they get bigger and bigger, they're going to have to find more customers, and they'll have trouble finding as many customers who are willing to fly for $250,000. So they're going to have to lower their ticket prices. Growth is not going to be directly proportional to the number of flights they increase. This is where we get into a bit of trouble. Virgin Galactic has said that they want to fly a whopping 400 flights per year per spaceport. And they have 6 spaceports currently planned, which means 2,400 flights per year. That is utterly ridiculous. I'm going to show you how it's utterly ridiculous on the next slide, but for the sake of being at least somewhat reasonable, I'm going to round down this goal to 1,000 per year. Here's the thing about flying 1,000 times per year, or roughly 3 times a day. On this slide right here is the entire history of human spaceflight. Every single flight from the Soyuz to the Dragon to the Space Shuttle, everything is on here. There have been a total of 363 space flights since Yuri Gagarin's first flight in 1961. That's an average of 6 flights per year. And here's Virgin Galactic coming along saying they want to do 1,000 per year. So on the next slide, we can see exactly how dramatic of an increase that is. That is a whopping 16,000% increase in the cadence of space flights globally. In other words, Virgin Galactic will have to fly 1,000 times per year with no escape system, and if at any point they fail, it will result in the death of 6 paying customers. So basically, this is going to have to be the most reliable spaceship in history by a massive margin if Virgin Galactic is going to be successful.
Yeah, Nathan, I mean, 16,000% increase with like no accidents, no mishaps, which, by the way, those will be catastrophic to the mission, to their company, if they even have one. There's an old saying in the military, they say 2 is 1 and 1 is none. And so, I mean, if you don't have a backup plan, that's just kind of really bad for business.
Yeah, exactly. And not only is reliability on this level hard, but it's also very expensive. And that's what we're going to get into on this next slide. So there is, in fact, a general rule for how expensive reliability is. And I learned this while reading a very massive book on the Apollo program. So basically, when the Apollo engineers were designing the program, they said that they would be able to tolerate losing 1 crew out of 100. That was the reliability target they had. If they had gone for a target of 1 in 10 instead of 1 in 100, they probably could have gotten the thing done for half the cost. And if instead of going for 1 in 100, they only tolerated losing 1 in 1,000 crews, the Apollo program probably would have been so expensive that we would have never gotten to the moon in the first place. So there is a general rule for this, and that is for every 0 you add to your reliability, every order of magnitude that you increase your reliability, it doubles your cost. The Apollo program had a reliability of 99%, or target reliability, and if Virgin Galactic did that, they'd be killing customers roughly once a month. And if they did 1 in 1,000, they'd be killing customers roughly once a year. So the bare minimum target reliability for Virgin Galactic would have to be 1 in 10,000, and that's at least. And additionally, the 99% reliability target for the Apollo program was including the escape system. So Virgin Galactic will have to have a spaceship 100 times more reliable despite not having an escape system, which is utterly crazy. So I did some digging, and currently the VSS spacecraft has a reliability of 1 in 10 based on their current track record. I think the VSS spacecraft has done 10 powered flights, and one of them resulted in the death of a test pilot. And yes, you might say that that crash was due to human error, and they've now patched out the problem that led to the death in the first place. However, every single crash is going to be due to something unexpected. Kenny, I'm sure you actually know quite a bit about this, but it's quite easy to control your known unknowns, but the hard part is controlling the unknown unknown. And that's what they'd have to do to achieve this bare minimum of 1 in 10,000 reliability.
Yeah, so actually in the military, in special operations, when dealing with the known unknowns, we actually designed or stole a complex framework called operational design to deal with these types of things. To deal with these things, you literally developed an entire complex adaptive system to deal with complex adaptive systems. So yeah, it's not an easy thing to do, and it's definitely a monumental task for Virgin Galactic.
That's the point we're trying to get at. It is theoretically possible for them to achieve this sort of 1 in 10,000 level of reliability, but they also have to do that while keeping their costs below what they're bringing in from the ticket sales. Doing this at scale is going to be really tough because they're going to have to bring in new people who aren't as familiar with the spaceship design. They're going to have to hire people at relatively lower wages. They're going to have to turn these spacecraft around at very fast rates. And the odds of them being able to do that at such a high cadence, an unprecedented cadence, without making even a single mishap is just a bit beyond what seems statistically probable. So overall, that is our current stance on Virgin Galactic. It is, technically not impossible for the business to succeed, but it would take some extreme statistical hacking to make it happen long term. So right now, the business is looking like a very high-risk, low-reward play, and your money is probably best spent elsewhere. But in case you are somehow still interested in the company, or you're interested in making a trade on this, Kenny is going to show us the technicals.
Yeah, thanks, Nathan. Just really quickly, all I'm trying to show here is just two lines. First is 1583, which was like the line in the sand when it was coming down off its all-time highs. It's touched that a bunch of times, but the more important place or the more important number that I want you to look at is $8.88. And you're like, Kenny, why did you put out $8.88? Essentially on the gray to the right there, those are like nodes on these little mountaintops. That's where most people have their money parked. So those are supply zones. So this is volume profile showing where the most volume of trading. So it's used as a proxy for supply. What I'm trying to tell you is $8.88 is where the most supply is. So if you're thinking you're going to swoop up and go over $8.88 and just have a free, easy time to get through that, probably unlikely. The one thing I will say though is if you've watched it over the last couple months, it is pretty kind of stable at this point. The volatility has dropped off and it looks like it is definitely probably found a volume. And you can see that on its month over month beta, which is actually quite low.
So I'd say the general takeaway here is even though we're not too optimistic about their long-term business model, I wouldn't suggest going short because as we said, they're not particularly short on cash, but they might run into problems at any point in time during their scaling up process, which makes it a little too risky to hold this company. And even if they do succeed, they're looking at flying 6,000 people per year to the edge of space for a 6-minute zero gravity experience. It's not like your money is going to be doing a whole lot to benefit humanity as a whole, even if they do succeed. So there are probably much better companies to invest in, and we would say avoid Virgin Galactic. All right, well, let us know what you think about Virgin Galactic in the comments. Again, sorry for taking so long with this video. We definitely should have brought it out a whole lot sooner because I know some of you are holding the stock. But again, let us know what you think in the comments, and if you aren't already subscribed to Kenny's channel, Red Cliff Research, go take a look.
Thanks for having me, Nathan. See you.